Hi guys, Brett Warren here, your trusted Brisbane resource, and today I'm joined by Mike Mortlock again. How's things, Mike?
Yeah, very well, thanks, Brett.
Thanks for joining us again, mate. Look, Mike works for MCG Depreciation, has helped a number of our clients with their portfolios, and today I just want to talk to you a little bit about what you do, and can you explain a little bit about your job and what the benefits of depreciation are for people who are considering investing and things like that?
Yeah, sure. So depreciation is one of those things that property investors don't tend to know too much about until they meet with their accountant. So essentially, my expertise is construction cost estimating. With tax depreciation, there's, I suppose, some accounting legislation that goes as part of that as well. So we have to be registered tax agents. So essentially what we do is we estimate the construction value of the property, and we break that down into the fixtures and fittings as well. So in a depreciation schedule, you'll see individual values for carpets and hot water systems and air conditioners and that sort of thing. So the ATO basically says that these plant and equipment assets have a certain effective life. So with carpet, it has an effective life of 10 years. So those effective lives drive the depreciation rates, and those depreciation rates just basically show the decline in value of the assets. So when you have a tenant in your investment property, they're wearing it out. We don't necessarily assess how fast they're wearing it out, but the tax office says that there are sort of statutory rates. So what we do is we estimate that value, we apply those rates, and then at the end of the financial year, you see a figure in your report. So if you have $10,000 worth of tax deductions based on the wear and tear of the property, then that comes off your taxable income. So if you earn $80,000 a year, you minus those tax deductions, and now the tax office is seeing you as only earning $70,000 a year. So depending on your marginal rate depends what deductions or what cash you actually get back in your pocket. But if you're on a 45% marginal rate and you're getting $10,000 worth of deductions, then there's $4,500 back in your pocket. So depreciation is just a great way for a property investor to help cash flow that investment property. So when you think about an investment, you've got your rent coming in, you've got your interest expenses. Often you'll be running the property at a loss. You can write that loss off on tax, and depreciation is sort of an on-paper loss as well. So often that means that an investment property might be costing you, say, $100 a week to hold on to. After tax, it might be zero, or it might even put some dollars back in your pocket. So if you can own an investment property that's going up in value, and instead of it costing you $100 a week to hold on to, it costs you $10 a week to hold on to, then that makes it a lot easier to service that, and hopefully you'll go and buy another property and get financial freedom.
Yeah, look, that's an interesting point, because a lot of people that I speak to, people forget about depreciation. And look, if you're looking to run a business and treat your portfolio like a business, which most successful investors do, that's a very key component to reduce that shortage and that cash flow. And even if it is coming in as positive cash flow, something you can potentially put towards the next deposit or the next property or something like that as well.
Exactly. Yeah, I mean, the stats are still saying that most people only have one investment property, and I think a big part of that is we tend to be emotional about the property. I'm not a property investing expert, but you can kind of see, working with property investors, they tend to buy places that they'd be happy to live in themselves, or they might be around the corner. It doesn't necessarily mean it's a bad investment, but there is value in treating it as numbers. And if you are treating it like a business, then you'll be looking at all the ways that you can to maximise the potential for capital growth and the holding costs as well, and depreciation's a key part of that.
Yeah, great. And if you've just purchased an investment property and you're an investor, when's the best time to get one done, I guess? And the second question is, if I purchased one 6 months ago and I've overlooked depreciation, it's something I should look into, what would you recommend doing there as well?
Yeah, I mean, the best time to do it is straight away. There's been some changes to depreciation. The reason why we've always sort of said you should do it straight away, because if you throw out some of the assets in the property, we've sort of captured them in the beginning, and you could have potentially scrapped those plant and equipment values. It sort of depends when you purchase the property whether that applies or not, but it is a good idea to look at it straight away, and that just sort of gets it out of the way. And that way you go to your accountant, you've already had your depreciation schedule done, and you can finalise your tax return. We certainly do see people coming to us that have maybe bought a property off the plan and they've owned it for one example was 8 years, they'd never had a depreciation schedule done.
Wow.
So our report will start from their purchase date, but normally you can only backclaim 2 financial years.
Okay.
So we showed those previous 2 financial years. In fact, we showed the whole 8.
Yep.
They went to their accountant, amended those previous 2. They may potentially have lost 6 years worth of those deductions, which in that particular situation was somewhere from memory 40 or 50k worth of deductions.
Wow. Yeah.
So really, really significant.
Yeah.
In some instances, your accountant can go back a little bit further. They might be able to get a special ruling, but in most cases, it's just those 2 years. So that's why we would recommend getting it done straight away as part of the purchase.
And once you have it done, you don't have to keep having it done every so often, do you? It's written off over.
Yeah, so the report lasts for 40 years.
Yeah.
Often people will say, well, what if I add something? Well, there's no estimating required. So if you add, let's say, a split system air conditioner, you'll know exactly how much you paid. You'll know when it was installed, and you can give that to your accountant.
Receipts and stuff.
Exactly. Yeah. And if it's 1 or 2 items, we normally look after those for free as well if the client wanted an updated schedule. Yeah. If they're doing massive renovations, let's say they add another story or they do an extension and they spend a couple of $100,000, the builders don't necessarily say, congratulations on your extension.
Yeah.
You've got a $1,400 oven, you've got a $1,100 dishwasher.
Absolutely.
So we may need to come in and inspect and get that breakdown. Because if you lump that all as building improvements, you're only getting a 2.5% rate.
Sure.
Whereas carpet after the first year can often depreciate at 37.5 if it's under $1,000. So there are other higher rates for plant and equipment deductions. So normally it'll last you the lifetime of the property unless you're doing major work.
Okay. Look, that's really interesting. I really appreciate you coming in and talking to the guys about that today. I think it's a real key component of the investment puzzle and something that's not being utilised enough. So people who don't have depreciation on their properties already or are interested in understanding a little bit more about it, because it is quite a complex issue, definitely get in touch with Mike at MCG Depreciation and he's the man to set you straight.
Yeah, absolutely. And as we were sort of just talking off camera, we won't do a report unless it's beneficial for the client. Right. So it's either going to put money back in their pocket or we'll say, unfortunately, it doesn't stack up for these reasons. So it's a pretty nice product to sell in that regard.
Absolutely. No worries. Thanks for your time.
Pleasure.
Thanks.